Greetings, listeners. I'm Bob Simpson, your host, and welcome to another episode of My Private Network. Today, our focus is on another one of our real estate concepts, self-storage. And let's just jump right in. Gabriel Millard is the managing partner, equity capital markets with Avenue Living, where he's been with the team since 2018 and managing the equity capital markets team since early 2020, overseeing operations of all the funds across various departments, including equity, sales, corporate finance, national accounts, and marketing. Gabe, thanks for joining us today and welcome to My Private Network.
Perfect. Thanks for having me, Bob. Excited to be here.
Yeah. No, it's as always, we prepare for these things and read bios and all that kind of thing. When I looked at your bio, it says you worked in Australia, San Francisco before taking this role with Avenue Living. What brought you home and to this current position that you're working at right now?
Yeah, I traveled around, in my first part of my career quite a bit. Australia and San Francisco was because where I was working was helping private companies, typically VC funded, manage their cap tables. And that was kind of where I got the started my career. And so those two areas are pretty high tech volume in terms of that, especially compared to Calgary or where Calgary used to be at that period of time. There was not as much tech happening at that time. What ultimately brought me back, though, was in kind of the 2017, 16 timeframe. And if you think about Calgary in that area, was a bit of a crash. I mean, we saw the oil crisis happening or the energy crisis happening in these markets. And typically I find that, opportunity comes from depressed times. And so wanted to come back home, see the family, but also see what kind of opportunities lay. And that's kind of how I got connected with Avenue Living, actually, was I was trying to start a company that was going to do crowdfunding for real estate investment, talking to the industry players. That's how I met Avenue Living, and then ended up actually coming on in 2018 to kind of help them grow and expand their capital raise efforts.
Yeah, one of the things that I've always wondered about is the name Avenue Living. Can you just, start there? Just tell me where that name came from, and then just talk a bit about the organization. It is a bit of an odd name, I always thought.
Yeah, I wish I had a better story than this, but ultimately, if you think of the two major players in the prairie markets, there's two public REITs, well, one a corporation, one a REIT, and it's Boardwalk and Main Street. And so not wanting to have the same style of descriptor. And so it started out as Boulevard and then went into Avenue instead, and then adding living on top of it just because somewhere that you live with it. So unfortunately, not a great story behind the name there. Ultimately with where, what Avenue Living is and what we do is, Avenue Living is an alternative asset manager. We maintain, private real estate funds, focus on three main verticals as multifamily, farmland, and then we'll talk about primarily today of self-storage. And really, though, Avenue Living was founded as a private operator first model. So, it was a co-founder wanting to start a real estate business, owner operator model. It wasn't until 2017 that we became more of an asset manager managing these individual investment funds. But really the ethos of Avenue Living is investing in the everyday. And so that is workforce housing, multifamily residential. That is your legacy run self-storage assets. And then building an operating model behind that. So we really focus on the operations first. We focus on building a business around it. So rather than just being a pure capital allocator, and we can talk about this throughout, we really focus on building an entire business for our funds.
Yeah, no, thanks for the background. But, maybe it's an idea, Gabe, that you hire a PR firm to come up with a better story for where Avenue Living's name came from, right?
100%. That's the first time I've been asked that for, for a very long time, and we changed that.
Yeah, exactly. So we're going to talk today about self-storage, and let's kind of just jump right in. Whenever I look at investment concepts, I love to start with trends, with demographics. I'm a big demographics believer. I bought a cottage because a demographer told me that I should go buy a cottage, that all the baby boomers were going to need to buy cottages over the next 20 years. And it's worked out really well, as any cottage owner knows. But, let's talk a bit about what's happening, in those regards in the self-storage space.
100%. So self-storage, it's been an industry that in the US has been around for around 3 generations. Canada, we're about a generation behind. It's been around for about 2 generations. And two really key things are starting to happen within this space. First, we're starting to see it be part of ingrained in Western society. So what I mean by that is in Canada, when I talk about storage, a lot of people still consider it as, well, is this not a luxury item? Is this not it's not a need, it's just a nice to have. And if somebody gets a little bit cash strapped, they're going to cut their storage locker and they'll no longer be renting it. In the US, I don't get asked that question. And the reason for that is it is so ingrained in society. If you think about a family that's grown up where the kid went to the storage locker with their parents, they just know that's just what you do. It's just part of the industry. And the reason that that's happened earlier in the US, especially in kind of the Sunbelt region where we tend to operate, is that there aren't any basements. So in Canada, we typically tend to have basements. You don't have basements because of the environmental side of things in terms of, with hurricanes and with the way that the environmental side of the way things are built, you don't have basements typically. So you don't have as much storage space. Well, combine that with what's happening also in terms of the development of multifamily within Canada and also in the US, is we've seen a stark trend towards smaller and smaller floor plates. Now, this is for many reasons, but developers have figured out that you can stack more units in and try and generate excess return that way. And so you have smaller floor plates for all of the new condo builds. Well, what are you going to do with them? Sometimes there's storage lockers involved, but they're typically pretty small and they also cost money. But if you want to store anything of real size, you have to start looking at a storage locker. So you've got two major trends that are really converging together. That is causing a serious increase in the demand for storage, which is why over the last kind of 5 years, we've seen a really strong change. And that's whether that's from investment firms or whether that's from even banks, where typically, it wasn't as popular to lend to storage sites, is now becoming one of the major pieces of what individuals want to lend on in terms of like CMBS pools. There's a lot of demand for storage backed assets. And so we're seeing that as a stark shift because there's been such a strong demand. And then probably something we'll want to talk about is the change in supply, or the vendors or the owners or the previous owners of who those self-storage sites were.
Yeah, and that's, I think as Canadians, we look in our own little world where we all do have basements. And I've been on tours of places in Dallas and Phoenix and that sort of place. And you see these massive houses with no basement. And you think, why don't they have a basement? But it's a huge place, but you're not going to keep your junk upstairs. You're going to keep it down in the basement like everybody else does, right?
Mm-hmm. That's exactly right.
Now, within that, there are a couple themes that I've seen because I've been on tours of some of the self-storage facilities. And one of the big trends or developments in that area is technology. And you come from really a technology background. So what are you seeing that's happening that is making self-storage a better investment because of the use of technology?
Absolutely. There's been a huge shift in the last few years towards using technology. And so self-storage has typically been the domain of your kind of eccentric entrepreneur. It's the vendors that we work with are some very eccentric people. And because it's a bit of a strange business, it's a unique niche. It always had been. But typically they would develop, own, manage. And it's a very strong cash flowing business. So it's an excellent business for a family or smaller entrepreneur to build up a portfolio of sites, run this. And you've been able to run this pretty well just by, either just signage marketing or, your classic, any of your classic old school marketing techniques of just having it being off of one of the major roadways and having somebody come by and pay cash rent for this. And it's an old cash and paper business. And it really didn't have a lot of technology invested into it. Now, take back 10, 15 years, some of the largest players have been consolidating the space. So the two main names that you'll see is Public Storage and Extra Space. They came through and they consolidated a large amount of the A-class downtown locations across the US and Canada. And they sit head and shoulders above every other operator in terms of the total assets that they manage. And they invested in technology and they've created some really unique features. And because of that, the industry has grown up alongside it. But what we've seen is that typically it's about 80 to 85% is what the estimates are. That's still fragmented into mom and pop ownership. And if you don't have the balance sheet or really the need, because you're a cash flowing business, to invest in the technology, you typically don't. It's not worth the extra cost if you're only managing 150,000 square feet. And so what we do at Minimal, and this is why I can speak to it so well, is, we're taking very legacy run assets and then bringing them into kind of the 21st century. And so the technology that exists today is really quite basic when you think about it. It's electronic gates, so that you don't need to be able to access the site only at 9 to 5 when somebody is there to let you in. It's an electronic kiosk out front. So if somebody's there, you can just go in and put in a credit card and you can get a code and it can lead you to your unit. It's a website that is SEO enabled, because most people, when they go to find a new storage site in today's world, will Google self-storage in their area and they will look at the top 1 to 2 options. Whichever one's closer and best price is typically where you end up looking, as well as then if you have a professional looking website. So we make sure that we're top rank of Google every time. You also can then go on and, it sounds basic, but it's not an option in a lot of places, is you could go on right now and we could pull up Minimal and we could go rent a storage locker in Hot Springs, Arkansas and get a code for it. Those are the style of things that we want to add. The other piece that's really unique to the industry, well, not unique, but is something that's happening now. It's unique for some of these legacy run ones that the institutions have been using for a while, is dynamic pricing. So very similar to the way that airlines will price their seats, is if you think about it, say 10 by 10s are in higher demand than 3 by 10s. Well, the pricing of 10 by 10s is going to go up, and the pricing of 3 by 10s can adjust down on a lower basis in order to track that demand. So it's always a kind of this push and pull of optimizing the price per foot while also ensuring that you are maintaining occupancy, but you're not too high occupied. If you're running at 100% occupancy, well, you're priced too low because you don't have the flexibility to adjust pricing higher. So it's a really nice kind of push and pull, and technology is being used in order to adjust that, because if you're trying to do that on a manual basis, you'd always be behind, and it would just be a colossal waste of human capital versus what technology can do for us today.
Yeah, no, it's interesting. And it is something that you can do at scale, but for the ma and pa shops, it's good enough is good enough, probably, right?
That's exactly right. I mean, what you're running, you've got a great margin, maybe a 65% margin, maybe 70% margin. You're collecting cash. It's creating a great business for you. You take vacations every winter. It's why invest? Why spend the capex?
Just go on vacation. We had a bit ago, and just talking about consolidation, we had a gentleman, Kent Wilmore, talking about farmland, and what he was saying is that most farms are, and you're in that business, most farms are still owned by farmers, but we're starting to see some consolidation. Is that when you look at the marketplace, are most places still owned by individuals, or what percentage would you say are owned by individuals versus the firms like yours or some of the mega players in the field?
Yeah, no, that's a great question. Yeah, something we're definitely familiar with as well, and very fragmented in the farmland space, and it's still fragmented in the self-storage space. So if you look at it, and if you were to drive through your major roadway in any of your primary cities across North America, you're going to think that there's 3 to 4 players, because you're going to see the same signs. And that's what's happened, is there is a consolidation of the primary locations and your A-class facilities. But as soon as you go into not even a bedroom community, but just your outside of downtown core, and then especially once you get into your secondary, tertiary markets, you start to see that it's still the domain of mom and pop. So we estimate 80 to 85%, both in Canada and the US, is still unconsolidated in the realm of your mom and pop owner. And so that was Minimal's strategy from the beginning. And so we've become very well versed in this market of areas that did not have that same institutional investment. So if there's a new A-class facility, it's typically the same players, the same owner and operators that are looking to acquire it. We often don't run into those guys because we're looking elsewhere where they're typically not going, because it takes a different kind of infrastructure in order to to go and enter into these areas and understand how to manage in what might be a smaller site. So very much still the realm of mom and pop, to the point where when we were first acquiring and first starting the business, we had to go out and we built an entire database ourselves of every vendor in Canada in terms of this, and started calling them. And we were cold calling people in order to acquire, because for them, they never really thought it was an option. The consolidation had already happened of the older assets that were in these locations. And then it was just, the same groups were buying all of the new development, but everything else had kind of just been left. And it really had been left to their own vices. And that's why you saw, them running cash and paper businesses, because there's no other competition. Why would you try and invest to make it better?
So one of the trends that we've seen, especially in private markets, is consolidators consolidating to sell. Is that something that, because the big pension plans, they don't want to drive around and cold call and try to drum up single locations, right? They're more looking, give me 100 locations, I'm interested, but anything under 100, I'm not that interested. Is that like, are you a buy and hold strategy, or do you look for putting packages together and then selling lumps to some institutions at premium prices?
Yeah, Avenue in general is a buy and hold. So multifamily, especially, we have no desire to ever sell, especially because Canadian real estate, once you sell a portfolio the size of Avenue's, you can't rebuild that in today's world. That is something that almost would be very difficult to try and build a portfolio the size of 17,000 units in today's world from scratch. In storage, the way that we've structured this is we have built this as an open-end vehicle. It is built to run forever. So we'll buy, we'll consolidate, we'll optimize, we'll generate cash flow, we'll return cash flow to the investors, and we'll see some capital appreciation along the way. That being said, to your point, in the storage space, there is a very heavy M&A market. And so you typically see the top two players, Public Storage and Extra Space, competing for these larger portfolios. So in the last 2 to 3 years, we've seen some very sizable deals ranging from $2 to $13 billion in terms of portfolio acquisitions. And those two tend to kind of fight for the deals from each other, whether that's from, Blackstone's BREIT self-storage portfolio. There was a life storage portfolio that was sold. There was a company called Express Storage, which very similar to us, was a fully remotely run self-storage portfolio in secondary, tertiary markets that was sold at a very strong premium. And you do see that there's a hefty premium to the individual cash flow that you're purchasing as a portfolio. And that's primarily because, to your point, the large institutions, they don't want to go buy a 50,000 square foot piece. You don't want to go buy a 100,000 square foot portfolio. You want to go buy 10 million square feet. 15 million square feet at once. So that's something that we're always open to kind of looking at. We're not actively, searching that. We're trying to build the best portfolio we can, consolidate as many assets as we can, and generate a strong yield for our investors. And then if there ever comes that opportunity, that's something that we definitely explore.
Yeah, just to change direction a little bit. I remember there's a TV show on called Junk Wars, I think it was called, and these junk collectors would go around and they would they'd open up a storage locker and walk in and go, wow, this is really cool, some of the stuff that's in here. I'd speak for myself, being an average kind of person, that I think it's a lot of junk that's in there, but it's not just junk that goes into these lockers. What kind of people and what kind of products are going into these sort of things?
Yeah, that's a great question. Yeah, it was Storage Wars, and great show, a little sensationalized. Still exists today in its own sense, where if somebody skips on their rent, we go in, and now it's all online, as everything is, and you film the storage locker, and then people will bid on auction, and they'll come by and pick it up the next day, and it's very interesting. But as far as what people are storing, it is as far of a bell curve or a range that you want to apply to this. It's there. There's no end in terms of just pure crap and all the way up to luxury items. So it's everything and everything in between. And yeah, we've got some funny stories. It's a wild business. But I would say that for the most part of what people are storing is what happens is you're moving, whether that's upsizing, downsizing, just moving in general. You need a storage locker for a few months while you're in between, and then 18 months later, you're still storing that old couch that you had.
Mm-hmm.
And that becomes part of it. And then once you're in, you're typically in. But we've got some funny things all the way up to, people paying $300 a month for a storage locker that they're storing a fake Christmas tree that they use every year. That probably costs $150 from Costco. So it's that, or it's all the way up to businesses. We do have a lot of smaller businesses that will store their stuff out of us. So at our Calgary site, we've got a Tim Hortons franchise that stores their extra like cups, etc., in one of our storage lockers. So it's everything in between that you can possibly imagine has been probably found in a storage locker.
And you don't tell people that, hey, you can take your stuff and when you do the renovations, get it out of there, put it in the storage locker. But you don't tell them when you move, once you get it renoed, you don't want that old junk back in there. So you're going to be selling it later, right? You don't need to tell that story, do you?
That's exactly right. But you can't sell it. What if you need it at some point? Maybe you never know.
And that makes these things pretty sticky, right? When people put stuff in a locker, you will get some that will be, based on I'm moving or I'm renovating, which will be short time, but you get others where they're putting their snowmobiles or their ATVs or they're putting things like that they just don't have in their condo. They don't have space to deal with that. So they're going to have to store it somewhere, and it's better than going buying a new one. Christmas tree might be a bit different, but
no, that one's a bit much. That's a bit extreme, but that's exactly right. And typically, it's some people use it the way they intended, and they'll use it for 2 months, and they'll get out, and that's great. But if we do find that if they last past that, then it's long term, or lots of things that people will just consider this as a long term storage because you're not going to get rid of your ATV just based off of storage space.
Of course not. Of course, you're not going to get rid of that. Motorcycles, different things in Canada, right? Now you talked a bit about, in just some pre-work, the prairies are starting to see some increased demand. What's happening in the prairies, and you've got boots on the ground in that marketplace, so you know it pretty well. What are you seeing that's happening in that marketplace?
Yeah, absolutely. So this is our home court is the prairie market. In self-storage, we're all across Canada, 15 different states in the US, and multifamily, we're into 5 different states in the US, but primarily in Alberta, Saskatchewan. But yeah, it's an interesting time, and the media and the headlines are starting to pick up on it, but we've been seeing it for a number of years. But there's been a big push towards affordability, and the ability of remote work is helping enable it. But really, since COVID, and the increasing and rising costs have driven a lot of people in what were hotter markets out of the affordability range. And it takes a lot, especially in Canada, to drive somebody to move provinces. But it's starting to happen. And we're seeing net immigration flows into the province at levels that we really haven't seen before. They're pretty off the chart. We're talking, 245% increases from, year over year gains in terms of the net immigration flows into the province. And it's something that is happening at such a fast pace that we're seeing a very strong demand, both on our self-storage product as well as into our multifamily product. And one of the big reasonings for it is that, we as in the prairies, we have a smaller nominal population than you see in Ontario, than you see in BC. But when you think about a nominal population, it doesn't take as many people in order to push a higher percentage change as it would have in some of these other markets. So as we see higher net immigration, and as Canada as a whole sees higher immigration coming into the country, it's not taking as much to drive these higher percentage gains of population influx. So it's a really interesting time where we're starting to see pretty extreme gains in terms of the rental market, in terms of the self-storage market, in terms of everything. But what also is happening is historically, Alberta or the prairies have been boom and bust. You see it as oil market was hot. So oil companies were hiring and people were moving for jobs because you could get a very good paying job. That's not happening this time. Oil market's doing fine, but these companies have been, they've been turned into lean machines after the 2014, 2015 kind of crisis, whether it's, a government pushing against it or just the advent of new technology and the not wanting to continue this through these cycles. There's not as much capex being invested. They're not hiring at the same pace that they used to. They're now able to run at a very lean clip and return cash flow to shareholders. And that's what's happening. So as much as that market is doing well, people aren't moving here for oil and gas jobs anymore. People are moving here because it's affordable. And they're bringing jobs with them or bringing other types of entrepreneurial ventures with them. So, we see that Calgary is now listed as the second highest tech growth rate outside of Vancouver, North America. We're seeing this as different restaurants starting to pop up as people bring that with them and all the other services that come along with a higher population. So it's really something that's starting to spread and really diversify the economy here. And we'll see, time will tell whether this is, a longer term trend or not. But to me, it's always been a stickier population gain because people are coming here because, you can sell your townhouse or your condo in Toronto and pocket some cash and come here and get a backyard and be 25 minutes from downtown. So it's something that to me is a longer term trend because you're not coming here for a job, you're bringing your jobs with you. So it's very interesting what's happening within the space right now. And it's really changing the landscape really of investment within the prairies.
Yeah, so all you really need is a couple of years of El Nino like we've had in Ontario, where it hasn't snowed, the weather's been warm, the sun's been out, and that could fool a lot of people into moving out there and thinking this is okay. And then they learn the harsh realities, right?
There is absolutely that. This year we joked about that a lot, of everybody that moved from September on has no idea what they're in for the next little bit. Although I will say this year we've had a very mild winter as well. So we'll see if that's a trend.
Yeah. But it's just there to fool you, right?
Yeah.
It's not something that's going to last. Yeah. So passive versus active investment in this space. What's important about being an active manager versus a passive manager? Or, how would you describe your firm?
Yeah, no, that's a great question. So yeah, we talk a lot about active management, and it goes back to kind of what we've been talking about of operations first, but it also applies to an asset manager and being an active asset manager. And really a way that I can kind of draw a parallel to what that means is within the wealth management space. If you think about it, a passive manager could be kind of analogous to a bank account or a savings account where, you park it, it's safe, and maybe it grows a little bit. Or you go to a financial advisor that has a charge for it, but they are going to help grow your assets over and above what they would typically grow at. In the same way that if you go and buy a building, there's, history has shown there's always been groups of individuals that go out, purchase a building, they hire a third-party manager, and then they let them do their thing. And what happens, and this is typically who we buy from, is that asset gets managed. The property manager, without somebody actively managing them, will collect the rent, they'll make sure it's clean, they'll make sure it's running, but they don't grow or they don't invest in the asset or they don't try and grow the value of the asset. Whereas if you have an active manager, whether you're doing your own property management or not, but you're pushing on the property manager, you're creating a business plan for this asset and growing that value, that's what we consider active management. And real estate, especially over in Canada, depending on where you were, you could get away with that. And in the US, the same was true. You could be a passive manager. You could buy a building. You could be a group of dentists from California, buy a building somewhere in Arizona, and your value was going up because the market was so hot. Same thing happened in Toronto. I mean, you couldn't help but make money if you had bought at any time in the 2000s. Alberta had been the boom and bust. So you didn't have that idea. You didn't have that opportunity. And since 2015 until about 2020, the market was tough. You had to create your own alpha. And so it's very important in today's world, now that we've seen, the fastest rate hiking cycle that we've seen in modern history. We're seeing rising costs at levels that we hadn't seen before. If you're not actively managing this asset and continuing to improve it, you're getting squeezed. And we've actually been able to acquire from a couple developers who had, developed a building. That was their skill set, was development. They figured they'd run it for cash flow. used a third-party property manager. And not that the property manager is bad or doing anything untoward, but they weren't actively being managed to improve the asset. So their costs kept going up, but their revenue wasn't going up to maintain it. And so they ended up selling out to us and wanting to go and do what they did of development. So it's one of those things where, a strong market can mask a lot of things, and passive management can get by during a time of rising boats. And I think we probably saw that in the stock market as well of, passive investing worked out very well. And it seems to be that we're entering into more of an active management side on that side as well. So it's a very interesting time now that we've reintroduced a cost of capital into the equation.
Yeah, let's turn our attention, in this space, because people who look for investments they look for a couple of things. They look for return, they look for risk, they look for liquidity. We recently did a podcast on liquidity. And in it, we said, when you buy things, it's almost kind of a spread game, right? Am I being compensated sufficiently for having my funds locked up for the risk that I'm taking, right? If we look at this, the one thing that I've noticed in your mini mall storage fund is the consistency of return. Like year to year, there's been like a 1 or 2% difference up in double digits. Where, just for the sake of our listeners, what's a reasonable expectation that you're seeing for returns within this area? Let's just start there.
Yeah, so our target returns is a 12 to 15% kind of target net return annualized over a 10-year period. And that's based off of, what we believe we can do on an underlying asset basis, plus any portfolio gains that you'd see as we continue to consolidate and improve the asset.
Yeah, so that's good return. Liquidity, there is liquidity premium in this type of investment. How long are you locking yourself up for?
Yeah, so the mini mall currently has a 2-year lockup period, and then there's monthly redemption window after that, which is a 90-day payout window.
Yeah, and we explained in our podcast about liquidity is part of the reason that you set that is because you don't really want investors who are coming in for investment for shorter periods of time, right? You're making longer term investments. You have to match that to the type of investors who are there.
Exactly. There's an inherent, there's an inherent gap or time period in terms of we're making long-term investments, and there could be, if you're pairing that with short-term redemption windows, you're going to find yourself into trouble. So you want a long-term investor who's wanting to park their capital for, at least a 2 to 3 year period, and we hope they continue to grow with us, but at least that time frame in order to be able to generate that kind of return.
Yeah. So just as we wind this down, interest rates, everybody wants to know how things are being affected by interest rates. How has the self-storage area been affected by interest rates, by the, its rapid increase in interest rates?
Yeah, I mean, interest rates has affected, all businesses, especially ones with, hard assets or rely on debt. One thing that was that has changed is that there was a major trend within the private equity space for development of storage. And the reason for that is because storage is pretty easy to develop compared to, say, a multifamily or commercial property. And so you could borrow at a zero cost, essentially, stack up a storage site in a relatively short period of time and flip that out to one of the larger institutions. That was happening in a lot of the major cities, especially in the US. And we saw a lot of players that ended up having to hold on to their assets because no longer people weren't looking to buy that as quick for lease up. And now you're trying to run with a higher cost of capital. It's the difficult scenario to be in. You want to make sure that you're able to operate in today's environment. It's really easy to clear and make something cash flow when you've got a 1% debt yield, or 1% cost of debt. It's not that hard to overachieve that. When you've got a 5 to 6% cost of debt, well, you better be able to operate your building pretty well. And the nice thing, though, about storage, and this is true for multifamily as well, is you still are operating with long-term debt instruments and short-term lease terms. So multifamily, 12-month lease term. If you take storage, it's 1-month lease term. So what that means is that, let's say your average is, say you have a 3.5 year weighted term to maturity. Well, in theory, on a portfolio basis, you've got 3.5 years of rent increases in order to offset any increasing cost of capital. So you know what's kind of upcoming. So it's a really good business to be in comparatively to, say, other forms of real estate where it might be, let's say, a commercial where you typically have a longer term lease term. You don't have the ability, as much as you got CPI ramp ups, that works when CPI is stagnant. If CPI is fluctuating, that can be more difficult. So we can operate and adjust in real time our revenue in order to offset that rising cost of capital. So you just have to be able to make sure that you have a business and back office that can actually operate and go out and get those rent increases in order to achieve that. Ultimately, it doesn't matter in the end if you've got a 5% cost of debt, if you're getting a 7% yield. Or if you have got 2% cost of debt and a 3% yield, that still works, but it gets to be really hard if you bought for a 3 cap or a 3% yield, and all of a sudden your cost of debt went from 2.5% to 5%, the math no longer makes sense. So that's the difficulty that a lot of operators are facing. So it's one of the reasons we've always wanted to focus on higher cost of or higher cap rates at the entrance, but also then being able to manufacture yield on top of that in order to create a buffer of what that cost of debt is.
So just to stay in that direction, is what's your level of leverage in this particular investment?
Yeah, so mini mall is about 48% LTV. And so just under 50, and that's typically where we end up playing. Storage is a lower levered business typically than you would see in multifamily. A lot of that just has to do with the lending standards. Banks don't typically lend over 60% on an individual asset for storage. But also in today's environment, it's not worth it taking that excess risk of having a higher leverage. So we tend to play around that 50% mark, and right around 48% currently.
Right. And how do you handle the debt? Are you more fixed term, or are you more floater on this?
Yeah, it's about 93% fixed. For our assets, most of them are on long-term fixed instruments, typically through either CMBS pools or just conventional mortgages with most of the tier 1 banks. We also have an acquisition line, so we will often acquire an asset on the acquisition line. That's where the variable rate of debt of that remaining amount comes in, and then that allows us time to optimize the asset, improve the building, and then rotate that out into, say, a CMBS pool. Often too, because of the size of these, so multifamily, you're buying a large building, easy to put a mortgage onto it. If you look at storage, if you're buying 25,000 square feet or 30,000 square feet, banks aren't interested in lending on something like that. So you create a basket of goods. You end up getting a couple 100,000 square feet, and then you can go out and rotate that out into one instrument.
Right. So leverage is low, financing is largely fixed, so there's not a lot of interest rate risk in this investment.
No, we don't see a lot of interest rate. We when it started and when the announcements were coming, I think, we went faster and harder than anybody saw coming, but we also are not in the game of taking risk through interest rate or trying to predict what's going to happen. We buy, we optimize, and then we rotate into long-term debt. That's what we're looking to do. So we were already in a really good scenario of fixing most of our debt.
Yeah, no, that's wonderful. Anyway, time's up for today. Thanks, Gabe, for joining us just to help investors understand this better. I think it's awesome that you've taken the time to work with us today. So thanks so much for coming out. Appreciate it.
Appreciate you having me. Always a great time chatting.
It is fun. We try. So before making any investment decisions, it's crucial to consult a professional financial advisor to determine suitability. Full disclaimers are available on privatedebtandequity.ca. Now, also, please don't forget to follow us on your preferred podcast platform and subscribe to our YouTube channel to stay updated on new episodes. If you're eager to learn more about today's topic, we have dedicated a channel to self-storage on privatedebtandequity.ca where you can learn more. I'm Bob Simpson. It's been my pleasure to guide you through this enlightening conversation. Remember, knowledge empowers you to make informed investment decisions. Until we meet again, stay focused and disciplined on your financial journey. Thanks very much.